I've already said you should reserve one space in your portfolio for gold. Remember I said it could be a miner or an ETF that mirrors the price of commodity like GLD? And another space for a speculative stock. I know, heresy, but that will keep you interested with the potential for gigundo gains. Next, you need a good old-fashioned growth name, specifically what we call a secular growth stock. Now, on Wall Street, secular has nothing to do with public versus parochial schools or the establishment clause in the First Amendment, which is what I learned because I went to law school. I know you can live without it. On Wall Street, when a company has secular growth, it means that unlike cyclical smokestack growers, the earnings of a secular growth stock aren't hostage to the health of the economy. They'll keep on expanding even during a slowdown because the product doesn't need a strong economy. When you get your hands on a strong secular grower, that stock can keep lifting. I like to think higher and higher, a la Jackie Wilson, going on to a new high after new high for as long as the growth lasts. And I always talk about the famous growth stocks of the era, the Chipotles, the Apple, the Deckers, Intuitive Surgical. Sometimes they're going to have some tough stretches, the Express Scripts, Salesforce.coms, or players like Amazon or Starbucks when they were in their prime growth years. Everything does get old after a while, though. So how do you analyze growth? Remember, when we buy a stock here, we're paying for a company's expected future earnings per share. We don't look at the past. This is basic valuation algebra. The share price, which we'll call P, equals the earnings per share, which we'll call E, times what's known as the multiple, M. E times M equals P. The multiple is the key. It tells us what investors are willing to fork over for a company's future earnings. And our E, by the way, we're speaking about future earnings, not past. Okay? And the most important determinant of what price earnings multiple, the vital ingredient that has the most effect on the size of the valuation special sauce, is the company's growth rate. See, we will pay a much bigger multiple for business with higher growth because that growth means the earnings will get larger and larger in the years ahead. As a general rule of thumb, when it comes to a high-octane secular grower, the stock can trade up to a multiple that's twice as high as the long-term growth rate before it gets too pricey, too expensive, too nosebleed. And that's what the vast majority of growth-oriented managers believe in. It's too steep for me. I try to come in underneath that. But if a company's growing its earnings, say, at a 20% clip, these people, these great growth managers, they would pay as high as 40 times earnings. That's not the way I do it, but I'm telling you what they would do. And typically a growth stock won't trade down to a multiple of less than 1 times its growth rate unless there's something seriously wrong with the fundamentals. Maybe they're changing. Or we're in such a nasty market that it's soured on everything, including growth, even secular growth. Perhaps because of higher interest rates, inflation, those things that makes multiples on growth stocks shrink because their larger earnings in the future become less attractive relative to increased yields that people can get from cash or from treasuries, which are risk-free. By the same token, lower rates make growth stocks more attractive and cause their multiples to expand, at least historically. Even more important, when you own a high-growth stock, you need to be especially sensitive to which direction the earnings estimates are going and whether those estimates are increasing at a faster or slower pace. That's the rate of change. These stocks can soar to a new high after new high after new high, but remain cheap as long as the analysts who cover them are raising their estimates per share quickly enough. When the estimates have momentum, a stock like an Apple can double over the course of 12 months and then double again. And the multiple would be lower than where it started because the earnings estimates have increased even faster than the share price has gone up. This kind of momentum allows the stock to resist even the downward gravitational pull of an ugly economy. Now, look, of course, you got to be very careful when you're playing with a fast grower, especially if it's been rising for a while, because as soon as the company misses a step, the second it reports a quarter that's merely good enough and not better than expected, the moment we learn that the growth might even conceivably be slowing a teeny-weeny bit, just slightly, that stock's going to get started. It's just going to get pounded. And the pain can last for years as it goes through a difficult process of George Costanza-like multiple shrinkage. Yep. Years, as momentum-seeking investors gradually pay less and less and less progressively for slower earnings growth until all the growth money managers get shaken out and the multiple sinks to levels where value-oriented investors with a different orientation, they like what's the fundamental worth of the company, not the growth, they become interested. When you see multiple compression, don't hang on for the full ride down. You got to just sell. The bottom line, to build a portfolio that can work in every kind of market, you need a fast grower, preferably a secular growth stock that has still room to run for multiple years. One where the earnings estimates seem like they're forever trending higher and higher.